There are a couple types of flexible spending accounts offered to employees: the Healthcare FSA and Dependent Care FSA. A traditional or medical reimbursement FSA allows you to contribute pre-tax dollars into an account that is available to you at the very start of the plan year, which you then may use for qualified medical eligible expenses. These expenses include medical services that apply to deductibles or copays, dental care, or vision expenses. The amount that you may put into an FSA is limited by the IRS at $3,200 for the traditional healthcare FSA. Funds you put into an FSA must be used within the plan year or they may forfeit. With the healthcare FSA, you can roll over $640 into the next plan year. Any amount surpassing $640 will forfeit once the next plan year starts. This is commonly known as the use it or lose it rule. Dependent care expenses may also be saved for through an FSA in a separate account. This works similar to a medical FSA, but is used for expenses related to dependent care, such as before and after school care, daycare centers, and summer day camps. The annual dependent care limit is $5,000. There is no rollover available with the dependent care FSA. It is important to note that with both FSAs to keep all receipts in case of an IRS audit. Failure to provide receipts for qualified medical expenses could result in having to pay a penalty. Medcom is our FSA administrator. If enrolled in either of the FSAs, download the Medcom app for easy-to-use service capabilities such as submitting claims and accessing account information.
You have a lot of important decisions to make during open enrollment. One of those decisions is whether to participate in your company's Flexible Spending Account, or FSA. If you are not familiar with this benefit, you may not be tempted to take advantage of it, but you'd be missing out on big savings. An FSA allows you to contribute up to $3,200 pre-tax into an account to pay for qualified out-of-pocket medical expenses. This includes things like co-payments and deductibles when you go to the doctors, deductibles and co-insurance when you are at your dentist, contact lenses, eyeglasses, or prescription sunglasses. In some cases, you can even pay for over-the-counter items like bandages and cold medications. Your FSA funds are available day one and paid back from each paycheck throughout the year. By contributing pre-tax dollars to your FSA, you lower your taxable income. In other words, you pay fewer taxes and take home more money. Let me give you an example. Say hello to Susan. Last year, Susan spent $250 in dental expenses, $900 in prescriptions, $200 toward eyeglasses, and $300 in office visit co-payments. That is $1,650 in out-of-pocket medical expenses that Susan already paid taxes on in her paycheck. If Susan had contributed this money to our company's FSA, she would have saved $400 in taxes. Ready to enroll in your company's FSA? There are just a few things you need to know first. Carefully estimate how much you'll need in your FSA. FSA dollars must be used by the end of the plan year or you lose them. There's one exception. You can roll over up to $640 of unused funds to use the next plan year. Once you've set aside funds in your flexible spending account, using them is easy. You can simply swipe your FSA debit card at any doctor's office, hospital, pharmacy, or qualified online retailer. Or you can pay out of pocket and submit for reimbursement from your FSA at a later date. Tracking your balance and submitting a claim for reimbursement is easy too. Simply log into our mobile app, snap a picture of your receipt, and you're done.
Each year, employees can elect to contribute a certain amount of their pre-tax income to their TSA. This money is then deposited into the account throughout the year, and employees can use it to pay for eligible dependent care expenses. Since the money is contributed pre-tax, it can lower an employee's taxable income and increase their take-home pay. There are several advantages to using a TSA to pay for dependent care expenses, including Tax savings. By contributing to ITSA, employees can lower their taxable income and increase their take-home pay. Lower out-of-pocket costs. Since TSA contributions are made pre-tax, employees may be able to pay for dependent care expenses with pre-tax dollars, which can lower their out-of-pocket costs. Flexible spending. TSA funds can be used to pay for a wide range of eligible dependent care expenses, including daycare, preschool, after-school programs, and summer camps. While there are many benefits to using a TSA to pay for dependent care expenses, there are also some potential disadvantages to consider, including use it or lose it rule. Any unused funds in a TSA at the end of the plan year are forfeited, so it's important to carefully estimate eligible expenses and not overcontribute.